fund manager Curtis has no intention of letting go of his position as the manager with the best record of delivering dividend growth for his investors. For the past 26.5 years, he has managed the assets of the City of London, an investment trust, in what he describes as a conservative fashion, never taking unnecessary risks and always running a diversified portfolio, albeit predominantly exposed to the UK stock market. But come hell or high water, for example, the financial crisis of 2008, the 56-year-old has always managed to increase the annual dividend payments to shareholders in the trust. It means an unbroken run of 51 consecutive increases in the trust's annual dividend. A record unrivaled in the investment trust industry.Crucially, as far as investors are concerned, Curtis sees no reason why 51 cannot become 52. He believes the equity income story is as powerful as ever, if not more compelling. He says, there are plenty of positives out there. While you have solid earnings growth across swathes of UK industry, particularly in oil and mining stocks and the banks. It is good to see Lloyds Banking Group back on the dividend trail, and the likes of BP and Shell benefiting from strong oil prices, global economic growth and cost cutting. With the dividend yield on the FTSE All-Share Index at 3.6%, there are not many more attractive income stories out there. Like all investment trusts, the City of London has the tools available to keep growing its income payments to shareholders, financial mechanics that are not available to unit trust managers. They come in the shape of income reserves and the ability of a trust to put aside a maximum 15% of all income received in the year and divert it into this income piggy bank. This then allows trusts to dip into these income reserves in the tough years in order to keep the dividend payments to shareholders growing. Curtis says that in 7 of his 26 years at the trust's helm, he has used these income reserves to top up dividend payments. Currently, the income tank has enough reserves to pay the equivalent of 3/4 of an annual dividend. Although Curtis likes the turnaround in the fortunes of banks and the mining and oil companies, it is consumer goods businesses that provide the trust's core, the likes of tobacco giant BAT, multi-brands business Unilever and drinks company Diageo, famous for brands such as Guinness and Smirnoff. He says, businesses that provide consumer staples are consistent. They invest in their brands and they often have exposure to emerging markets. Unilever is a case in point. Some 60% of its turnover is generated in emerging markets, and following the failed bid last year from American rival Kraft Heinz, it has become more shareholder-focused. Last week Unilever announced the closure of its Colman's mustard factory in Norwich. With 116 holdings, the trust has positions in a broad church of companies. Curtis would not have it any other way. It means the fund's overall performance, income and capital return, does not sparkle against rivals, especially those with a bent towards smaller companies, although it has proved a more rewarding investment than simply buying a fund tracking the FTSE All-Share Index. One further endearing feature is the trust's low ongoing charge of 0.42% a year, a fee that will reduce as the trust's assets grow.